Morgan Stanley wrapped up the big week's worth of results on Friday with some questionable news out of that bank. But amidst the shuffle, amidst all the bank news last week, was one bank that outperformed everyone. Sort of a little secret there we'll talk about in a bit. Let's start with Morgan Stanley. Gorman, you think he's pretty much on the hot seat this year?
Yeah, I mean, we've been pondering that for a year or two, right? So he takes over in 2010 after a year or two where he's been leading the restructuring after that big loss they had in the crisis, remember? And they decided to cut back trading, then get back into it. And they decided to buy under his
take over the wealth management
unit from Citigroup. And they bought another 14% of that last year, so they own 2/3 of that.
So it seems to have a pretty clear strategy that's churning slowly towards somewhere.
Exactly. They said last week a wonderful new corporate speak phrase was, "We're now ready to pivot into really good returns for our shareholders." Pivoting is it's a great idea. And what he's talking about is, look, we made. If you strip out all the noise, they made about a 4% return on equity for the fourth quarter.
Which was the worst, basically.
It was pretty much, B of A is probably roughly there as well. Now, the good news versus B of A is that they've got a lot more momentum, and this is what he's talking about with his wonderful pivot phrase. So if you look at the wealth management unit, they made a 17% pre-tax margin there, which is the best they've done since who knows when, certainly since before they took a majority stake in the City unit. They're looking at maybe a 20% when interest rates are better, well, better for their business at least.
And plus once they get full control and the whole thing.
They get full control, the costs of integrating the two have now sort of tailing off. So that all helps get the...
But he's basically got to get to double-digit returns sometime this year, or you think investors are just going to be fed up with the whole thing?
Close to, I mean, 4% is pretty bad, right? And you think even Goldman Sachs managed, by cutting pay, managed to get to just over 10% return on equity for the full year. Right. And Morgan Stanley is a bit more challenged on that simply because it's got that wealth management unit where you pay normally just below 60% of your revenue out to these guys. On the investment bank, they cut it, but it's still at 42%, which is way above Goldman's 37, 38%.
Okay, so there's more to do there. Let's pivot ourselves to U.S. Bancorp, which has among the best valuations in the market. It's a big regional bank. It's trading close to 2 times book, I think. They also had results. Kind of got lost in all the madness of J.P. Morgan, Goldman, and all that stuff. Tell us what you've been thinking about there.
They are the next biggest bank in America after you look at all the big guys. They're the next biggest bank. They have $350 billion worth of assets. So compare that to Wells, which is $700-800 billion or so, and then all the others come after that. So it's a pretty big bank. It's exceptionally well run, having sort of gone through a number of mergers in the 90s and even a couple more in the 2000s. And it's got the best efficiency ratio of any of the banks we look at. So it's about 51% of their revenues go to cover.
So what's the story there? Why are they
I think they just keep it nice and simple. So it's not a question of whether they do investment banking or not, but I think that helps. It's, look, we have a good mix of businesses. We do a lot of fee business, more than some of our peers. They're about almost 50% is fee business. So they're not so tied into the interest rate problems that a lot of the regular banks are. But they've also, by not stretching for earnings anywhere and just saying, look, we'll do this, we'll do that, we'll do it properly, we'll keep numbers down, we won't reach for the skies, we won't overdo it, they can keep their efficiency ratio lower. And also, they just run their business relatively well. So they get a 16% return on equity in an environment where everyone else is struggling to get double digits. I mean, it's
16% versus 5% sounds like an interesting contrast. We'll keep an eye on both those banks and be back with more Breaking Views tomorrow.